Hello and welcome back, Equity Trust Company patrons and future successful clients. My name is John Bowens, and in today's installment of the Self-Directed Roth IRA, we will discuss the advantages and disadvantages of establishing and/or converting your traditional IRA or tax-deferred funds to a self-directed Roth IRA to achieve 100% tax-free perpetual compounding growth. This webinar, backed by popular demand among so many of our clients, was designed because of the concerns many of our investors have regarding the current tax policies and the adverse effects that tax reform may have on our customers' investment portfolios. As you can see on the screen, if the Bush tax cuts expire, we all, regardless of income level, will be affected in one way or another. An increase in marginal tax rates, long-term capital gains rates, and short-term capital gains rates has certainly left many investors in a predicament. Many investors are turning to the use of retirement accounts to prevent the taxation of their real estate and other alternative investments. With over $16 trillion in debt this country faces and the inevitable rise in tax rates, many of our investors are transforming their accounts into completely tax-free IRAs to prevent additional taxation in years to come. Today we will show you how to implement a tax-free Roth IRA into your investment strategy and provide all the information you need to get started immediately. Before we discuss the Roth IRA, we should discuss what most investors currently hold, which is a traditional IRA or tax-deferred IRA. So for those of us with a 401k, 401a, IRA, or other retirement account with our employer or financial advisor, we can roll over these funds into a self-directed traditional IRA. These funds have not been taxed as we received a deduction when we placed the funds into the account originally. Therefore, the federal government will tax us when we distribute the funds after 59.5. So we must ask ourselves, would we rather pay taxes now or later? Or would we rather pay taxes on the seed or on the crop? Many of our clients prefer to pay taxes now, grow their accounts 100% tax-free, and never pay taxes again. For these investors, they prefer to establish a Roth IRA. The Roth IRA is a tax-free retirement account. Again, the traditional IRA, you receive a tax deduction with your contributions, but when you withdraw funds after 59.5, you will pay taxes based on your ordinary income tax rate, a rate that many investors believe will increase for them personally in years to come. Conversely, a Roth IRA is funded with after-tax dollars. You will not receive a deduction for this, but profits will grow 100% tax-free, and when you distribute funds after 59.5, you will not incur additional taxation. So let's compare the two. Let's say I have a traditional IRA with $100,000 and a Roth IRA with $100,000. At the age of 59.5, if I took a full distribution of both accounts, I would pay far more in taxes on the traditional IRA distribution than the Roth. When taking the $100,000 out of the traditional IRA, a significant portion of this account will go to the federal government depending on my ordinary income tax rate, whereas if I take a $100,000 distribution from a Roth IRA, not a single dime in taxes will be paid. You can contribute up to $5,000 to a Roth IRA when you are under the age of 50 and $6,000 if 50 and over. In 2013, just a month or so away, you can add an additional $5,500 if under the age of 50 and $6,500 if 50 and over. Due to the limited amount we can contribute per year, it's important that we take advantage of these contributions in each year to increase the compounding effects of tax-free growth. We must also make you aware that not all individuals qualify for a Roth IRA. Unfortunately, high income earners do not qualify to contribute to a Roth IRA. If you are single and you make more than $125,000 modified adjusted gross income, you do not qualify for a Roth IRA. If married filing jointly and you make over $183,000 modified adjusted gross income, unfortunately, you also do not qualify to contribute to a Roth IRA. If you are in this category, please don't be discouraged, as we have a solution for you wherein you can convert your existing funds from a traditional IRA to a 100% tax-free Roth IRA. At any time, you may convert existing traditional IRA money to a Roth IRA. Let's say, for example, you have $50,000 in a traditional IRA. You may convert this $50,000 into the Roth IRA and pay the taxes now rather than later. The taxes you will incur will be based on your ordinary income tax rate. Remember, you never paid taxes on these funds before, and therefore the government gives you the opportunity to pay the taxes in one lump sum and never pay taxes again on any of your investment returns. You may also convert just a portion of your existing tax-deferred accounts to a Roth IRA. For many investors, they cannot afford to convert the entire $50,000 to a Roth IRA, but they understand how powerful tax-free investing is, and so they will convert $25,000 in the first year and leave their existing traditional IRA with the $25,000 to continue to grow tax-deferred. Also, for those of you who currently have real estate or other alternative assets in your traditional IRA, you can convert these assets in kind to a Roth IRA. You may also convert a portion of a property or other asset from your traditional IRA to a tax-free Roth IRA. Distribution eligibility. You may begin taking distributions tax and penalty free from the Roth IRA when you reach the age of 59 and a half and have held the account for more than 5 years. If you are nearing the age of 59 and a half, it's important you are aware of this provision. If you establish your account before December 31st, you can begin distributing funds in 2017 opposed to waiting until 2018 before you can begin distributing funds tax-free. Contributions can be distributed tax-free. At any time, the amount you have contributed to a Roth IRA can be distributed without taxes or penalties. For example, if I established a Roth IRA today with $5,000 and grew the account in 1 year's time to $10,000, I can take the original $5,000 out at any time tax and penalty free, but I have to wait 5 years and 59 and a half to distribute the $5,000 in earnings. I refer to this feature as the safety net provision. Always keep in mind with the Roth IRA, if you have an emergency, you can always distribute the funds you originally contributed tax and penalty free. If you currently hold a savings account with a local bank or credit union, you are paying taxes on the interest you accrue within that account. Why not place these funds into a Roth IRA, pay no taxes on the interest you accrue, and always have the availability of those funds if needed? No distribution requirements. As many of you know, the government requires you to take funds out of the traditional IRA at the age of 70 and a half. They force you to take these distributions. The Roth IRA can grow and exist for 100 years without distributions. This can not only be a great tool for retirement planning, but estate planning as well. This account can be left to your surviving spouse, children, or grandchildren without taxation to them. So let's discuss 3 of the most frequently asked questions amongst our customers. Number 1, if I convert funds from the traditional IRA to a Roth IRA, will this amount be added to my ordinary income tax? The answer is yes, but this should not discourage one from converting to a Roth IRA, but rather prompt them to complete an analysis of their situation and determine what makes the most sense for them financially. Equity Trust Company also encourages you to speak to your tax professional, CPA, or at least crunch the numbers on your own to determine if the movement of these funds will benefit you financially in the long run. Number 2, if my spouse doesn't have earned income, can I still establish an account for them? Absolutely yes. Only one spouse has to have earned income to contribute to both accounts. For those of you who are just getting started or you're looking to maximize your contributions, in the next month and a half, you can have over $20,000 in retirement accounts to begin investing in real estate and other alternative assets immediately. Number 3, when is the deadline for establishing the Roth IRA and converting funds to a Roth IRA? The deadline is December 31st to be taxed at current tax rates. It's important if you believe your tax situation will change, not in your favor, that you take advantage of this opportunity as soon as possible to guarantee the arrangements can be made well before December 31st. It is absolutely imperative that if you are serious about transitioning your funds, you call Equity Trust Company immediately to avoid any delays or possibly missing out on converting your funds altogether. Now, as we discussed earlier in the webinar, tax rates will increase without action from Congress. As you can see, marginal tax rates will increase by 3% for most of Americans. And as a result, this can have a dramatic effect on converting funds from a Roth IRA before December 31st of this year compared to next year when tax rates may increase. To illustrate the dramatic effects of increasing tax rates on a Roth conversion, we have the analytics associated with one of our customers' accounts who has recently converted their traditional IRA funds to a Roth IRA. This example will also illustrate the significant tax savings one can achieve when using the Roth IRA to grow wealth tax-free without the diminishing effect of taxation on long-term growth. George and Rebecca, who consider themselves middle income, make just about $110,000 adjusted gross income. George and Rebecca buy and hold single-family homes for cash flow. Their average rate of return is 9.7%, which is far greater than the returns they received in the stock market in the past 10 to 15 years. The beginning balance is just over $75,000, which is considered just above average according to the Employee Benefit Research Institute. So let's begin by showing the tax savings George and Rebecca will achieve by investing in real estate with their Roth IRA. For this example, we are assuming the Bush tax cuts have not expired and their marginal income tax rate is 25% compared to 28% if the Bush tax cuts expire. If George and Rebecca continue to invest with a 9.7% rate of return, they will have over $480,000 at the age of 65, starting with only $75,000 and adding no additional monies to the account other than the returns on their investments. If George and Rebecca had made the same investment with their taxable monies, they would have just $307,000 in savings. So as you can see, taxation on investments can diminish the compounding effects one can achieve with their investments. In this case, George and Rebecca will save over $173,000 in taxes by investing with their Roth IRA. In this example, we are preparing for the worst-case scenario and assuming that the Bush tax cuts do expire for George and Rebecca, and they are now subject to a 28% marginal tax rate. With the same figures as before, you will find they will achieve an additional $16,000 in tax savings as tax rates have increased while the Roth is still growing tax-free 100%. The total tax savings, assuming the Bush tax cuts expire and George and Rebecca's marginal tax rate increases to 28%, is $189,455. We show you these examples so you understand the value in investing with a tax-free retirement account and the effects taxation may have on your retirement portfolio. In addition to the long-term benefits, we also need to do an analysis of whether it would make more sense to convert before December 31st of this year or wait until next year to convert funds. This certainly is contingent upon tax rates increasing or decreasing for George and Rebecca. George and Rebecca assume to have the same income or more next year, and therefore they believe their tax rates will increase as well. If George and Rebecca convert before December 31st, they will pay $20,239 in taxes. If they wait until next year, they will pay $21,526 in taxes. By converting in this year, they will save $1,287, assuming their tax rates do increase. Given the facts, we encourage everyone to analyze their current situation to determine how they can achieve additional tax savings. If needed, we recommend you contact your tax professional or CPA to discuss your situation and determine if a Roth conversion makes sense for you. For immediate access to the calculators we displayed earlier, you may visit www.trustetc.com/investment-calculators. Again, that's www.trustetc.com/investment-calculators. For additional information regarding the Roth IRA or Roth IRA conversion, we invite you to call our account executive team to discuss your specific situation and assist with establishing your Roth IRA or converting your existing IRA to a tax-free Roth IRA. Establishing a Roth IRA or converting funds to a Roth IRA can be accomplished in as little as 10 minutes. In fact, due to the demand for these arrangements, Equity Trust Company staff is on call to facilitate all your requests. As you can see on your screen, the dedicated hotline is 877-819-9519. When calling, you will be assigned to a senior account executive who can answer all of your questions as well as assist with preparing all of the paperwork necessary. Again, in as little as 10 minutes, our account executives can prepare the paperwork and begin the account establishment process immediately for you. We encourage you to act immediately if this makes sense for you, as time is limited between now and the end of the year to make all of the final arrangements. Again, call today to 877-819-9519. 877-819-9519. On behalf of Equity Trust Company, we look forward to continuing to service your self-directed IRA needs and contributing to your long-term financial success. Thank you.